Policy as expected with a slight twist. That's what we could define the current monetary policy announcement made by the Reserve Bank of India governor earlier today. The MPC has voted unanimously in favor of holding the repo rate at 6.5%. 5 out of 6 members have voted in favor of holding the stance as withdrawal of accommodation. This was something that has been going on for the last 2 policy announcements as well. Now this is the third time that the RBI has made this announcement. On the surprise side of things, the RBI introduced something known as an incremental CRR or incremental cash reserve ratio. Now, typically cash reserve ratio is maintained at 4.5% of all net time and demand liabilities. That's the entire deposit base of the banking system. Now, in addition to that, for incremental deposits that were collected between a specific period of May 19 to July 28, for that deposit base, the RBI is introducing an additional CRR requirement of about 10% on those deposits. This is primarily aimed as a short-term measure for liquidity management by the Reserve Bank of India. Remember that incremental CRR was something that was announced back in November 2016 as well, when demonetization took place and the banking system saw a huge influx of liquidity. So a similar measure, however, at a much smaller scale, at only 10% requirement, is being introduced now. And the RBI says that this is primarily because of the high liquidity in the banking system, which the banks have not been parking with the variable reverse repo rate auctions that the RBI has been conducting repeatedly. That the response of the banking system for that VRR has been quite lukewarm, is what the RBI governor said, and banks have been displaying activities of risk aversion with the high liquidity that they control. So this short-term measure is intended to address that high liquidity position. According to the RBI's assessment, the banking system will still have adequate liquidity to fund any credit needs that of the economy that will be needed even during the festive season. The RBI will review this incremental CRR on September 8th or even earlier, depending on how the liquidity position evolves. Apart from this, the RBI is also talking about introducing a fresh set of norms for interest rate resets as far as floating rate loans are concerned. That is expected to increase transparency in the system. Lastly, we have to remember that the RBI has also revised its inflation forecast for the current financial year to 5.4%. Remember during the last monetary policy meeting in June, the RBI had revised this inflation expectation from 5.2% to 5.1%, and now it has gone up again to 5.4%, primarily being driven by vegetable prices. The RBI estimates that the vegetable prices will see a significant correction in the coming few months, and that the headline inflation number will therefore come down.